Ladies and gentlemen, good morning. My name is Henry Faun. سيدتي وسادتي, السلام عليكم, شكرا لكم, حياكم الله, وأهلا وسهلا إلى the Wealth Report 2021 من شركة Knight Frank. It is my absolute pleasure to welcome you to the 15th edition of the 2021 Wealth Report. Against the somber backdrop of the COVID-19 pandemic, we are thrilled you can join us today for the Middle East launch of our flagship publication here in Dubai. You are all extremely welcome. For this year's virtual launch, we are delighted to be collaborating with the Dubai International Financial Centre, the DIFC, one of the world's most advanced financial centres and the leading financial hub for the Middle East, Africa and South Asia. We are pleased to be joined by Salmaan Jaffery, the Chief Business Development Officer at the DIFC Authority. Today's Middle Eastern launch is virtual and relevant for any client with an interest in real estate. Please go to full screen to enjoy the full benefit of the presentation. Over the next 45 minutes, we will lay out the key themes and highlights of the Wealth Report, presenting our insights on private wealth, its impact on property markets, and then the evolving trends and opportunities that undoubtedly lie ahead in real estate and beyond, from both a global and more localized Middle Eastern perspective. The key takeaways from the report this year are as follows. Firstly, real estate remains immensely attractive to private clients globally. Notwithstanding the economic uncertainty and global pandemic, the love affair with property continues. Let's not forget our clients have, on average, almost 1/3 of their net worth in real estate, from homes, lifestyle assets to investments. Here in the Middle East region alone, 31% of ultra-high net worth individuals are planning on purchasing a property in 2021, with the demand for prime residential property remaining robust throughout the whole of 2020. Secondly, and crucially for the property market, global wealth creation has shown resilience. As you will shortly see, there are now over 500,000 ultra-high net worths globally, and in the Middle East are expected to grow by almost 1/4 over the next 5 years. The number of billionaires will also increase by 36% over the same time period. Let's see where this wealth is being created and look at private wealth's attitude to investment and risk in these uncertain times. I will now hand over to the esteemed Liam Bailey and the Wealth Report team to lead us through this year's findings. Following from that, we'll hear from Salmaan Jaffery. Liam, over to you.
Liam, I'll just jump in there first. Ladies and gentlemen, good morning and welcome to the live launch of the Wealth Report. سيدتي وسادتي, السلام عليكم. شكرا حياكم الله. اليوم أنا هنا لأقدم عليكم تقرير البحث The Wealth Report 2021. أهلا وسهلا بكم. To recap, we are joined today by our speakers Liam Bailey of Knight Frank and Salmaan Jaffery of the Dubai International Financial Centre. By way of background, Liam is the global head of Knight Frank's research department. He leads and coordinates the projects for the UK and internationally for clients including developers, investors and funders. Liam has worked on projects offering support for property strategies in local, national and international contexts. Over the past decade, Liam has led the development of Knight Frank's wealth research stream, culminating in the annual Wealth Report publication, which we are discussing today. Moving on to Salmaan. Salmaan Jaffery is the Chief Business Development Officer for the Dubai International Financial Centre. Salmaan has held leadership roles at global financial services and consulting firms, with work spanning North America, Asia and MENA. We will shortly hear from Liam and Salmaan on their respective areas. And should you have any questions that come to mind throughout, please do type them in the Q&A box at the bottom tab of the screen and we'll pick these up towards the end. So Liam, over to you. Please do share with us your insights of the Wealth Report.
Thank you very much, Henry, and welcome, ladies and gentlemen. If I go to my first slide, this to me is a really fundamental question. It's one that underpins this year's report. So we're obviously in the middle of a global pandemic and we've had an ongoing economic crisis in many parts of the world. So we ask ourselves, why should we be interested in wealth and in the wealthy? Well, fundamentally, for the property market, we've been tracking the impact of private capital on property market performance for over 15 years through the Wealth Report. And in the prime residential market, the link is obvious because the market basically comprises the wealthy. But one trend that we've been monitoring is how private wealth has become critical to the performance of commercial markets over the last decade. Nearly 1/3 of all property investments are now driven by the wealthy, either through direct purchases or through their own companies. And an understanding of the behaviors and attitudes of the wealthy is fundamental to understanding the global property market and how it works. And that's the knowledge gap that the Wealth Report aims to fill. So over the next few minutes, I'm going to outline our key findings. And I'll do this by focusing on 5 themes from the report. And behind the headlines I share, there's a huge amount of detail and data in the report that allows you to investigate market opportunities in greater detail. So my first point is that the global response to the pandemic supported wealth portfolios. And let's think about wealth creation for a second. The global policy response to the pandemic supported the wealthy. I mean, we're kind of back to global financial crisis territory. Lower interest rates, more fiscal stimulus mean that asset prices have surged around the world. And our wealth sizing model confirms that the world's ultra high net worth population rose by nearly 2.4% in the past 12 months to more than 520,000 individuals. That's a record number. And that process has been seen across the world, but it's Asia with a 12% growth over the past 12 months that's seen the really big upswing. And this is one of the key narratives that we explore. Now, the US, for example, remains the world's dominant wealth hub over our forecast period, but Asia will see the largest growth in ultra high net worth individuals over the next 5 years, well above the global average. And by 2025, we'll host around a quarter of all ultra high net worth individuals. And there's a significant read through here to the Middle East because Dubai, for example, is a natural hub for wealthy investors from Asia, particularly, for example, India, where ultra high net worth individuals are expected to rise by 60% over the next 5 years. So that opportunity to attract wealth, tourism, business investment from Asia is massive, and Dubai is incredibly well placed to capture this. Now, looking ahead, the outlook for the Middle East is positive. We expect a 25% rise in the numbers of ultra high net worth individuals over the next 5 years within the Middle East as economies diversify away from oil. And even more striking is the growth of high net worth individuals, so dollar millionaires, rising in the region by about 32%. In fact, the number of billionaires in the Middle East is expected to increase by 36% over the next 5 years. A second theme that we consider in terms of wealth is that growth in wealth itself is a risk to future wealth creation. So nearly half of our attitude survey respondents expect the growth in wealth inequality to fuel demand for policies aimed at curbing imbalance. Over the past 6 months, we've seen new or proposed wealth taxes in places like Argentina, Canada, and South Korea. And it's a key part of the wealth discussion and the tax discussion in the US and will be replicated elsewhere. And again, Dubai's ability to remain competitive on personal and business tax is a significant benefit in terms of attracting business and talent. And that differential is set to become a much bigger factor working in favor of Dubai as governments look to pay for COVID spending over the next 5 years. Let's think about this question. So COVID has accelerated lifestyle changes with profound implications for cities. This is a big theme we look at in this year's report. Urban centres appear to be a major casualty from the pandemic. Wealthy residents were reported to be leaving cities. CBDs have been facing lockdowns, and retailers, for example, have been staring to the abyss in many locations in Europe and in North America. But against that backdrop, we take a deliberately positive view of cities in the report this year. There's no doubt that the wealthy have been favouring suburban or rural property over city property. But there's a counterpoint here. Our data for London, for example, shows that we hit a record high in terms of the proportion of London-based buyers who are not sellers, i.e. the surge for country retreats, for example, in the UK reflects a growth in housing consumption amongst the wealthy, i.e. there'll be more second homeowners in the future. And we'll see in a moment actually how changes to working patterns and the use of the office opens a real opportunity for redevelopment and regeneration. One of our key findings is actually that the pandemic, far from undermining the city, has shown the potential for rebirth. And it's striking that when we ask in our attitude survey which property sector is most in demand amongst wealthy investors, development opportunities moved into 4th place for Middle Eastern wealthy investors. And it's a significant focus for growth. And one of the related areas is a new focus on ESG, environmental, social, and governance criteria for investing. And for example, the opportunity for Dubai and for other cities in the Middle East to innovate through lower emission buildings and green tech, etc., within the built environment is a major pull factor for investors who are looking to ensure that their portfolios are meeting ESG criteria. My next theme, demand for prime residential property has risen globally. Now, Kate Everett-Allen, who writes this section of our report, our head of international research, she confirms that house prices are rising globally because of and not despite the pandemic. And there's several themes here. Low mortgage rates, a search for space, changing commuting patterns have all helped to push prices higher. And the Attitude Survey reveals a growth in demand for rural coastal properties with access to open space as being the most highly desired feature. The pandemic is supercharging demand for locations that offer wellness, so think of mountains, lakes, and coastal hotspots. And demand, we believe, will help to fuel price growth of up to 7% in our key markets this year. Just for an example, London saw 28% drop in prices over the past 5 years, and with inflation and currency impacts, prices are down 40% since 2014. And in addition, we see that in locations like, for example, Dubai, despite the fact that prices have softened in most of the key markets in the Middle East over the past couple of years, demand for prime property in Dubai has remained robust throughout 2020 into this year, with signs of recovery in price performance in some markets, particularly the Palm Jumeirah. London lays claim to the top spot in terms of the largest number of homes considered prime in our global city analysis, over 68,000 homes worth over 2 million or more. And Dubai comes in second in terms of its stock of prime properties within the city. Our Attitude Survey reveals that 26% of ultra high net worth individuals globally are planning to buy a new home in 2021, and that rises to 31% across the Middle East. And when we ask a question, okay, which markets are Middle Eastern investors looking to purchase within, the UK, the US, Turkey, Spain, and the UAE top the list in terms of where that demand is moving to. My fourth theme, the pandemic has disrupted commercial real estate and boosted investment and innovation opportunities. This issue this year is a really interesting one about the behavior of the private investor, despite the fact that overall property investment volumes fell in 2020. The private investor actually saw an increase in their relative strength. So actually the capital deployed by private investors was 9% above the 10-year average in 2020, far stronger than the 6% fall in the amount committed by institutional investors over that period. And that trend is set to continue this year, with a quarter of ultra high net worth individuals in the Middle East and globally planning to invest this year in commercial property. And a key area of focus for the Wealth Report is our assessment of how the pandemic is driving real estate innovation. We've tracked where private wealth is being directed, but most importantly, we've assessed how the COVID crisis has accelerated market trends, opening opportunities for investors. So the Attitude Survey confirms that tech disruption is actually driving demand into sectors like data centers, life sciences, etc. And spurred by the pandemic, these specialist sectors in the office market are actually kindling new demand for investment. And with a third of Middle Eastern investors more interested in ESG criteria than 12 months ago, expect a rapid demand for green, energy efficient buildings over the next few years. And just looking at the Middle Eastern investor in a bit more detail, wealthy Middle Eastern investors are claiming through our report and our survey work this year that their top 5 areas of focus in terms of commercial property investment: logistics, PRS, healthcare, data centers, and also development land. My fifth area of focus is luxury investment trends. So we cover this area each year in the report. It's a key component of the Wealth Report, that actually our ability to take a wide view of the wealth portfolio is a really important aspect of the report, because it shows how investors are looking to search for returns in a lower interest rate environment. Over recent years, we've developed a unique tracker, the Knight Frank Luxury Index. It tracks the performance of luxury collectibles, but it also confirms the search for returns in a low inflation world, which has led to a growing demand for new asset classes. And for example, in this year's report, we point to sales, unique sales. For example, a 12-meter long, 66 million year old T-Rex skeleton sold in October of last year for $32 million in New York, a new record. And the results of our index confirm that despite logistical challenges, investors continue to drive values higher for key luxury assets over the past year. So led by, for example, collectible handbags, which we illustrate in this year's report by the sale of a Hermes Himalaya bag, which sold in November of last year in Hong Kong for nearly 450,000 US dollars. And that's a market segment which really led and pioneered online auctions, helping liquidity even through the lockdowns. Other sectors to see strong performance were classic cars, up 6%. However, as physical auctions were put on hold, the art market saw values fall by about 11%. On that note, I'm going to hand you back to Henry.
Liam, thank you very much for your presentation. That was most insightful. I'm a particular fan of that T-Rex skeleton transaction there. Should anyone wish to read the full wealth report, we will circulate the download link to the attendees afterwards. So moving on to the DIFC, Salman, thank you for your time today. It's been a strong year for the DIFC against a turbulent global backdrop. Please do take it away and share more of your insights.
Super. First of all, thank you for the opportunity to participate in today's really opportune and interesting conversation. We really appreciate the partnership we have with Knight Frank. Look, for those who don't know the DIFC, I mean, we are a financial free zone, so physical, legal, and regulatory carve out in Dubai and UAE, designed to drive the accumulation of talent and capital and diversify the economy of Dubai and certainly UAE away from hydrocarbons. And by that token, I think it's been a smashing success over the 16, 17 years we've been in existence. I wanted to make 3 quick observations that I hope tied with some of the key observations from the Knight Frank report. One was about wealth. The second one was about real estate, and then a quick commentary on the role of cities and urbanicity, as it were. Regarding wealth, look, this links to the Knight Frank observation on ultra high net worth, or the growth of wealth, and I can second that observation by simply saying that the DIFC market for wealth is a big market. It's growing, it's changing. While it is still the case that offshore wealth does go predominantly offshore, that trend over 20 years has moved quite significantly, no thanks to the establishment of platforms such as the DIFC. So, we did a survey of our clientele. So these numbers are not like forecasts or massaged, but our clients said that roughly the size of the market was 425 billion. And so the question is, how does that break up? Well, it'll be interesting to note that roughly about 325 billion of that is relationship managed. So there's a DIFC relationship manager managing capital from sovereigns, institutions, families, individuals, right? And about 100 billion is portfolio managed, which means someone's actually making investment decisions from the DIFC into global markets. On the relationship management, I think the key takeaway is that today, it's a roughly 50-50 split between kind of wealth from private from the wealth segment versus institutions, and at the relationship management level, it's still predominantly a kind of a U.S. manager-led game. But what's interesting is that the dynamics change a little bit. The other way of looking at it is if you take the 425 billion, 400 of it is client money, and about 25 billion that we can measure. So these are response-based. I'm sure the number is much higher, is proprietary capital. So that 400 of client money breaks down into, again, 325, which is relationship managed, and 75 that is portfolio managed. And there what you see is the regional play starts becoming more important. So more money that is portfolio managed is regionally managed, and the mix between institutions and wealth starts to skew in favor of more of wealth rather than institutions. But in general, this area is known for sovereigns, but the key message is that private capital is super important and family capital is super important as well. On real estate, I want to link to the observation that was made that real estate requires significant innovation. I second that observation also. Let me make a few comments on real estate, not just as an asset class, but as an asset. So, since our mission is to aggregate capital and talent, we know a thing or two, or we've learned a thing or two about the importance of physical footprint and ecosystem and how that contributes to the aggregation of obviously people who are very good at what they do. We were watching through the pandemic, and people said, "Oh, this spells the death knell of the office," and then the other pendulum swing was, "Oh, everything's going to be digital." And as it turns out, neither is the case. It depends by segment, and it's evolving. But the key thing that we are seeing is that innovation, as the report suggests, is critical, and getting the right mix of the physical and the virtual layer, I think, is a key success factor. And I'll tell you, we have gotten it right recently with the success of this our innovation hub, which we launched late last fall, and within a matter of a couple of maybe 6 weeks, we sold out a large amount of space with over 20 innovation clients. But we did it because we were able to shape the product to boost client productivity. We were flexible about design. We were looking at it was client driven rather than product driven, and there was innovation in kind of contracting as well. And on the virtual side, space was not the defining factor. Space was a critical piece, but those innovation firms, which include the top global firms in payments, money services, and other innovation, as well as regional firms, would not have come here if not for the soft infrastructure. The fact that we had the right rules updated, the right incentives updated, the right regulations, venture capital regulations, money services regulations. So the key takeaway here is innovation is critical. Enablement of clients is absolutely important, and partnership is key. Landlordship is not sufficient in this new era, and the DIFC is pivoting really, really well in this space. Last but not least, a quick note on, I guess, what I would call urbanicity, or the importance of the city. I think from our vantage point, that seems to be absolutely the case. Yes, people are flocking. Well, in other markets, maybe here too, people are flocking to more space, flexible space. But I think the city is equivalent to the Dubai story. This is a place of reinvention. The ability to attract talent is one of the major things which drive cities to be successful. And in Dubai's case, we are 3 years into a massive drive of innovation, and particularly Dubai's interest in digitizing the economy. Some examples include, the Dubai blockchain strategy, the partnership with MasterCard and Smart Dubai to launch cities of the future, His Highness Sheikh Mohammed bin Rashid Al Maktoum's announcement to launch a $1 billion dirham fund for innovation, and we are playing a role in driving that innovation story for Dubai. That fund, it's public information, will be in the DIFC, and our future finance strategy has taken essentially our fintech strategy as a financial center and pivoted that into a broader view on digitization. So without further ado, let me yield the floor and pass the mic back to you guys. Thank you for the opportunity to share my views.
Salman, fantastic. Thank you very much. That was very interesting indeed. Great to hear the latest at the DIFC. So, ladies and gentlemen, we'll now move on to a short question and answer session to wrap up today's presentation. Salman, whilst you're on, we'll continue with you if that's okay. Liam just mentioned that much of the new wealth globally is actually being created in China over the past year. Have you seen this wealth flowing to Dubai, and has the DIFC benefited?
So a bit of context: the flows between China and this region are not new. The DIFC has played a role in intermediating those flows. One example is that the big 4 Chinese banks that support the state-owned enterprises of China in Africa, not to mention other regions, are all based here, all have balance sheet here. They fund and finance tremendous amounts of trade and business. So that part is not new. I think it is also known that the Chinese diaspora here are a critical part of the community. There's something like 5,000 Chinese businesses here, and the Chinese have definitely been active investors in real estate, as everyone knows, certainly the last 5 to 7 years, through the peaks and troughs of Dubai's real estate markets. From a wealth perspective, we are absolutely seeing an interest in the an interest in Chinese businesses and families looking at the DIFC and other jurisdictions to start to diversify their holdings naturally, globally, particularly if you look at Hong Kong and other jurisdictions. There's a view to diversify and not concentrate all personal family wealth in one jurisdiction. Dubai DIFC is a very stable environment. And so yes, there has been an uptick in that, and I know that there's a fair amount of interest underway.
Excellent. Thank you very much for that insight there, Salman. Liam, over to you. More locally here from the Middle East, what cities and markets looking outbound are high net worth clients here in the Middle East looking to invest in at the moment?
Thanks, Henry. It's quite clear from this year's report. We ask a question in the attitude survey as to where ultra high net worth individuals are looking to invest from each world region, and when it comes to Middle East investors, the UK tops the list, as I mentioned in my presentation, followed by the US, Turkey, the UAE as well. But I mean, other European destinations also feature, so Switzerland, France, etc. I think it's interesting looking at the patterns of purchase over the past year or so, because the major problem that the pandemic introduced was an issue around travel and accessibility. So actually, wealthy investors from the Middle East have been a feature of the London market, obviously, for a long time. They were certainly buying in 2020 and the beginning of this year. They've been featuring. But I think the issue that we've found, of course, is that there's are people actually able to travel and access markets at the moment? And I think that when we look at our buyer registrations, for example, we're seeing a huge amount of Middle Eastern buyers actively registering their interests. They're talking to our agents on over the phone, etc. But actually committing to purchases is something which is just made more difficult by the pandemic. My guess is that actually once we move into the second half of this year, and actually travel is reopened, we hope, particularly because the UK is obviously leading quite well on the vaccine front, that actually we should then see quite a bit of transactional activity beginning to take place. But I think my guess is it's those markets which have always appealed to the Middle Eastern buyer, which will again kind of reassert themselves. And I think London will lead, but I think there's many locations across Europe and certainly across the US that will also feature as well.
Excellent. Thank you, Liam. That's great. One more here. We've had emailed in just before we started the session this morning. Perhaps one here for you, Liam. To what extent do you think that the interest at the moment in the Middle Eastern high-end residential market has been spurred on by concerns over taxation plans in other jurisdictions? And the scope of this is actually particularly in Europe, to plug a gap and a deficit caused by the global pandemic.
I think this is, like I mentioned it in the presentation. I think this is a really big issue because it's, and I kind of draw parallels to the global financial crisis, because we're almost back at the same point. Okay, it was a different cause, but ultimately it's the same effect. Governments across certainly Europe, but also North America and other parts of the world have had to dig deep into their reserves or build debt to pay for the pandemic or pay for the pandemic response. The question is not yet being asked actually in detail because we're kind of still in the pandemic, but very soon, by the second half of this year, the question begins to come around as to how do we pay for this? Who's paying for this? And it was interesting looking at the budget in the UK last week, that the Chancellor in the UK, Rishi Sunak, his ability to, and his room for maneuver is limited. Actually, who are you going to raise taxes on? And in the end, he settled on corporate taxes for the moment because it seemed the most politically kind of palatable solution. And even those he's delayed for a couple of years to ensure that we get a recovery from the pandemic. But I think it was an interesting one because I think he was taking a bet or a gamble that, Brexit Britain doesn't want to be unattractive to corporate investment, but there he is raising corporate taxes. But his assumption, I think, is that actually just every other country in Europe and North America is going to have to do the same thing because there's no alternative. And then you move beyond corporate taxes and you think, well, okay, what else could you do? And the obvious next group then is wealthy individuals. And as we saw with the in the financial crisis or after the financial crisis, you can't move very far on that particular topic without beginning to impact on behavior. So actually wealthy individuals will migrate and will move if they're taxed too highly. So I think governments are aware of that, so they will try to remain competitive. But I think the pressure now on many locations across Europe and other parts of the world are such that actually you have to expect more talk around wealth taxes. And we've seen it in the last 3 to 4 months. Argentina, South Korea, Switzerland, even many other locations are already imposing wealth taxes, reviewing wealth taxes. And I think it's obviously an area of opportunity for Dubai and for other parts of the Middle East, because if you are currently tax competitive in quite a significant way, if you can remain tax competitive, then there's a big opportunity coming over the next few years in order to potentially attract more mobile capital if it feels that it needs to seek a new home.
Excellent, Liam. Thank you. The question, I can see 2 or 3 have come in that are related to wealth taxes on a more global scale, which is a very interesting topic there and perhaps a wider theme to be discussed. Salman, I think there's probably one here for you. It looks like a family office question here. When looking to establish a single family office in the UAE, what are the benefits of setting up within a DIFC structure?
Yeah, look, I think the answer to this, I think touches on some of the themes that Liam has mentioned also, because the amount of global connectivity across not just taxation, but compliance, regulations, and legal matters is the world is super connected. So let's take a step back and make a few observations. The first is that while jurisdictions like Dubai DIFC remain tax competitive, we are subject to all the same compliance, KYC, AML forces that are critical, that governments are pushing globally, obviously for multiple reasons, ranging from security to revenue collection to transparency. And so the challenge for us as a financial center, which we've met, I think, quite well, is to maintain those benefits that grease the wheels of business, which is to not have onerous tax regimes, but also to not shirk on the responsibility for maintaining high standards. So one observation is, while there's absolutely nothing wrong, and I'm not a lawyer, there's absolutely nothing wrong with offshoring. We are not an offshore jurisdiction. Okay, and so what that means is on a variety of issues ranging from double taxation treatment to compliance to bank account opening, we have advantages that increasingly many offshoring jurisdictions don't have. And that's something which we are differentiating ourselves on. We don't sell ourselves. People don't come here to save money on taxes, by the way. Now, how does that fit into the answer to your question? We have over approximately 120 or 130 families here that have decided to structure business and personal assets. So that's a robust part of our business. Part of that is, of course, the single family capability. The high level answer is essentially you get all the benefits of the jurisdiction, which are broadly known about taxation, but also we are an English common law jurisdiction. We have our own companies law. We have our own courts. Contracts here are easy to do. There is recourse. And in the practical nature of, when you manage your family assets, whether it's family wealth or family corporate interests, we have tried and tested structures ranging from prescribed company structures to holding company structures to foundations, trusts, all these things. They're tried and tested. They're very good. and they provide flexibility. So if you're a family, a regional family, or a national family that wants to come here and manage your assets, it is a successful place to do so. I mean, there's details, but at a high level, that's what you want to do. And one last thing I'll say, not to be underestimated, is the importance of having a one-stop shop. Right, we have over 3,000, almost 3,000 firms here. And we have the world's top legal firms and accountancy firms and advisory firms and tax planners and all this kind of stuff. And so when you come here, right, in an afternoon, you can do a deal, meet a lawyer, structure a deal, complete a transaction all in one place. It shouldn't be underestimated.
Fantastic, Salman. Great insight there into structuring in the DIFC. This is perhaps one for both of you, and maybe a slightly more broader topic question than what we've been looking at today. But with all of us working from home over the past, well, a little bit over a year now, perhaps, and many continuing to do so, where do each of you see the role of the office place in the future? Perhaps Salman wants to continue that one first.
Yeah, I mean, it's you know, we're learning as we go, and we're very client driven. I think optionality and flexibility is absolutely critical, right? So we don't know how things are going to go exactly over the next 6 to 9, 12 months with international companies that are headquartered in multiple jurisdictions, who transact over multiple time zones, with populations or employees in multiple parts of the world. So the key is to maintain a degree of flexibility, which means it is not just about a particular type of space. It is about providing your clients optionality in terms of how they engage with clients in space, how they use it, how they scale up, scale down, scale sideways, how they integrate technology into how they work on a daily basis. Do they have flexibility in terms of the employment law to be able to do things differently? Are benefits flexible? So for us, it's all about flexibility and being client-centric. I've mentioned the success of the Innovation Hub. That's a great example of, again, making sure that there's really good alignment between the physical infrastructure and the legal and soft infrastructure. That's the place to start.
Thank you, Salman. Liam, any thoughts on the matter?
Yeah, I think, well, like Salman, I think you know, it's one of the biggest questions now for real estate coming out of the pandemic, and we've had this, you know, acceleration of trends. You know, it's been called the biggest, you know, global workplace experiment, you know, ever. I think, but my guess is that, you know, we saw a lot of reports last year that, you know, the office was dead, and, you know, there's going to be a radical shift, and everyone will work at home and so on. But you know, it works for a period, and if you have an established team, and then you're all told to go and work at home, that's fine. You know, if you've got good internet connection, you can do it for a period. But you try and embed new team members, you try and train graduates remotely, you try and embed people into your team. It's really hard, and actually, you know, passing down skills to new members of a team, to actually sort of train people, to nurture talent and so on, it's almost impossible to do it remotely. So I think I think that recognition is kind of there, and also the evidence from places like, say, Singapore, from Sydney and other markets where actually the pandemic has been less of an issue, shows that, you know, when you can go back to the office, people have been going back to the office. But I think, actually, to Salman's point, I think one of the big challenges, or actually opportunities, I suppose, for developers and for investors is, it does seem that people have kind of realized, you know, why do I travel, you know, an hour a day or 2 hours a day, you know, each way to go to an office, to come back from an office, to process email? What's the point? So actually, there will be times, there will be functions where increasingly it will be acceptable to say, actually, I'm going to work at home. I'm going to do a day where I'm going to focus on a report. I'm going to focus on email, whatever, fine. But actually, the office then has to persuade you. You know, the office provider's got to do something to persuade you to come in. If you're going to commute into an office, it's because you're going in for training, you're networking, you're meeting people, you're presenting to clients. The office becomes a much more dynamic place. And actually, the expectations, I think, from occupiers and from employees about an office becomes much more. It's not a series of cubicles to sit at, because I can do that at home. It's a much more dynamic place, a much more interesting place. And I think, actually, the outcome for investors and for developers is actually a really positive one, because this is an opportunity to rethink how we work and how we want to use space. So I think it's a big win potentially for the property market.
If I could just add, Liam's comments just spurred just one thought, one observation. I have to say that we could really take a page from what we've seen with our millennials, again, not to generalize, and our startup companies, because to Liam's point, you know, the traditional corporate activity is really ultimately about, you know, doing something on a computer, right? Checking emails, doing spreadsheets. But when you walk through a place like the Innovation Hub and see how startups work, it's not just email. There's product development happening. There's real R&D happening. There's testing happening. There's content being created. There's real collaboration happening. There is videos being shown, clients being, you know, it's much more than, as Liam suggested, you know, sitting there and checking email. And that to me is really interesting, I have to say. And I suspect that some version of that is going to leak into the popular consciousness when it comes to workspace, to the extent that it's relevant.
Fantastic, Salman. Thank you very much for that wrapping up. Ladies and gentlemen, there are a few more questions there that have been coming in, but we won't have time to go through them all. What I'll do is I'll reach out to those individually afterwards in follow-up. In follow-up to the presentation today, the Wealth Report download link will be circulated to everyone who attended. And so I will say here, thank you very much to Liam and Salman, and thank you to everyone who has attended the session this morning. For any questions, please do reach out to Liam and Salman and myself directly, and we're here to help. So thank you all for your time. Have a good morning.
Thank you.
Thank you.
Thank you. Bye-bye.